Hello and welcome. This is BloombergQuint. We are taking stock of earnings from Mastek. And well, the earnings look mixed. But to take us through the quarter and what we can expect going forward, I am in conversation with John Owen, the CEO of Mastek. John, good afternoon and thanks for taking the time out. Let's start with your assessment of the quarter, of the growth, which at least sequentially has been flat. We have seen an improvement in your operating margins. What factors do you attribute to this quarter's earnings?
First of all, I think it is a seasonally weaker quarter, so I think that's reflected across the industry. So I think if we are, let's look at our exposure to the UK, 76% of our business comes from the UK. So I am pleased that we stabilised in the UK from Q2, and I expect us to grow into Q4. And as you say, because we get so much from the UK with a favourable exchange rate, it allows us to maybe offset some of the performance we've seen in the US, which has been a little bit weaker. But again, I expect that market to recover in Q4. So I think your introduction was probably fair. It is a mixed bag. But I think if you look at the underlying fundamentals of our ability to manage external factors, the ability to manage sort of seasonal shutdowns, particularly in the UK with our biggest customer, when you move that forward, the fundamentals for Q4 look encouraging. So I think we're turning a corner. So I think your reflection is fair, it's mixed. But if I look at the underlying fundamentals, I'm quite encouraged about where we're going, and we should get back to our trajectory of growth that we've enjoyed in the last 3 years. Right,
John, I understand that furloughs may have also played a part as far as this quarterly earnings go, but looking forward, if you could give us an idea about what the deal signing has been, how things have panned out for the quarter, as well as the pipeline, so as to get a better outlook and better sense for Mastek.
Yeah, and I think, again, if you look at it through the UK lens, we went through a general election. The government essentially shuts down for about 6 weeks. So there are projects that have moved to the right from a bookings perspective. But I'm pleased to report lots of those are starting to come through as they go through the approval process. So I think Q4, our bookings position should be strong. And it's probably, hopefully, one of the best quarters that we've had in bookings. That, in fairness, just corrects for some of the softness that we've had in prior quarters. From a revenue perspective, it should flow into revenue, and if you then look at that coming through into earnings, I expect us to be holding our operating EBIT. From a US perspective, again, the organizational change we've made is flowing through into more activity. We're putting more salespeople and investment into the market, and I start to see, looking at their pipeline, I'm confident that the US will recover and then kick on through fiscal 21 to get back to some sort of growth. But I think the US it's a difficult market. It's very retail orientated, and I think we all look at the retail segment, and it is globally quite a depressed segment. It's got its challenges. So I think overall, at a group level, I'm encouraged where we're going. I think we've stabilised. I look at the forward-looking indicators of pipeline, order book, converting that to revenue. I'm encouraged where we'll be, and I think now we've got a better cost structure moving forward. I think we'll have more flex in the organisation, which should allow us to yield better earnings in the long term.
Right, John, just a final word then on, the macros of the US and the UK markets. We've been talking to a lot of your peers, and there is a suggestion that at this point, clients are in general not very confident about spending and, discretionary spending. And also when it does come to allocation in terms of technologies, a lot of them are currently still choosing between allocating funds towards your traditional legacy businesses, that is your run the business, as against your newer digital initiatives. What is your reading, and what kind of conversations are you having with your clients here?
So I think you're right from a macro. I think a lot of people will look at the US and seeing there's an election, and the jury's out about what does that mean for spending. So in that market, I do see discretionary spending probably being held off. In the UK, if you're in the digital world, I think the UK, the UK, I think, now has some clarity politically as the UK exits Brexit. And I think political stability is going to give a lot of confidence back to discretionary spend. So a lot of the UK market didn't spend in 2019 calendar. I expect that to come through into 2020. But again, I think as people go and they become digital companies, the reality is they can't afford not to spend in digital. It is about driving market leadership. It's about informing your customers, your citizens, whatever it is. I do see, I'm more confident about fiscal 21 than lots of my peers. And a lot of it is through the lens I look at, through a very strong UK government business, a UK general economy that's probably going to feel a little, it's going to get some tailwinds from not spending last year. But I think the US is probably, the jury's out on the discretionary spend. And, you know, in fairness, to be balanced, our exposure to the US is not that great. It's 25% of our business. We'd like it to be a bit more, and that's what we'll be working towards. But I think we'll look at the UK, and we feel optimistic going into the year.
Okay, John, we'll leave it at that. Thank you so much for taking us through these earnings. Thank you.
Pleasure. Thank you very much.
Hello and welcome to BloombergQuint. JK Lakshmi Cement has come out with its quarterly numbers with margins increasing by more than 450 basis points to 15.1%. Joining us is the company's whole-time director, Mr. Shailendra Chouksey. So if you could tell us the volume, you know, what the numbers were during this quarter and how much it has risen on a year-on-year basis.
Well, on the volume front, we don't have much of a story. In fact, our production is down by about 6% at 21.07 lakh tons, while in terms of sales at 23.27 lakh tons, it is almost flat compared to the corresponding quarter of the last year. However, if I compare with the previous quarter, then the numbers are an improvement of nearly 12% over the previous quarter.
And what is the volume outlook looking like, you know, going ahead into FY21?
Well, going forward in the FY21, we are quite bullish. We expect things should be much better. With the rural economy doing better on the back of a good monsoon in this year, and also on the expected announcement by the government in the budget to capture the infra spend of 102 lakh crore that the finance minister has talked about. I think there will be a significant improvement in the total outlay on the infra various components in the budget this year.
Well, sir,
and I think that should augur well for the cement industry.
Okay. So your EBITDA has actually increased, you know, due to the logistic costs, and also there was a change in the product mix. Could you quantify the cost reduction and, you know, talk about the change in the product mix? You know, what we can expect, you know, for the fourth quarter FY20?
There has been a significant improvement in our logistic cost in terms of our efficiency that we have been able to bring about. And also with the help of some improvement in the prices, we have been able to improve our EBITDA considerably in this year, in this particular quarter. And going forward, I think these factors will continue. We don't expect don't see any reason for prices to take a dip, or we don't see any reason why our efforts to continuously improve our efficiency would be slackened. So I think the only thing positive will happen is the volume, which we saw a dip in production this year, in this quarter. So I think going forward that should improve, and therefore when the multiplying factor improves, there should be a much better number going forward. That is what our expectations are.
And what do you intend to utilize the funds, you know, which will be raised via ECBs? That's roughly almost, you have raised, or you have given, the board has actually given the approval of almost $25 million.
I think we have just completed our last bit of project that we had undertaken for our capacity growth with the commissioning of our Cuttack grinding unit, which we did in the month of November. I think the way that we need to deploy the funds that we generate, apart from repayment of the debts that we have taken, I think it's time that we draw out our plans to increase our capacity further. And that is where we would like to conserve our cash flows for.
And how is the pricing power looking like in the northern regions? The channel check suggests that 2 price hikes of rupees 10 per bag have been already undertaken this month.
Well, I don't know about the 2 hikes, but I do know that there is an improvement in the prices compared to the corresponding quarter last year, which were at very, very low level. In terms of so I expect that price to continue, and that should support our buoyancy for coming time.
So overall, how has the demand been in the region overall, and any kind of green shoots are visible right now?
Well, the demand in the overall has not been very optimistic, and has been at a low key, keeping in line with the economic situation that we witnessed in the first 9 months of the year. So I think cement could not have been otherwise, and that's why we have noticed almost either a flat growth or a degrowth in most of our markets. But going forward, we are much more buoyant. As I mentioned, that the monsoons have been fairly good in wherever we operate, and therefore the rural economy and the overall economy, there should be things should be looking up, which should result in much better growth in cement consumption.
How much has the debt come down to, and can you quantify the growth capital that you will be spending in the second half of FY21?
You see, our debts have come down to about 1,600 crores currently, which takes our debt equity to a very healthy level of about 0.9 and on a net debt basis about 0.7. We have a repayment plan of about 250 to 300 crore every year, which will be done this year also. Apart from that, there is no other project which is right now under commissioning. We are only one project which is left is the completion of the waste heat recovery project, the second one that we are trying to put up at Sirohi, which should get completed by July this year. Thereafter, we have no plans as far as no project in progress thereafter.
All right, sir, we'll leave it till there. Thanks for talking to BloombergQuint.
Thank you.